And Dom, we'll begin with you and what's happening with mortgage REITs and Tom Barrack's warning.
Yeah, so Tom Barrack's warning is about those mortgage REITs in large part because many of these mortgage REITs have seen a huge amount of distress. I want to call your attention to two in particular. One is the Invesco Mortgage Capital Real Estate Investment Trust, and the other is the New York Mortgage Trust. Both of those in just the last month have lost around 80% of their value, and that's only because they're bouncing today off very distressed levels. The reason why they're distressed is because these mortgage-related REITs typically don't invest in real estate properties, they invest in mortgage bonds. And the reason they're in distress is because when mortgage bonds, commercial mortgage bonds, residential ones, loans of any kind of variety start to lose value, these funds actually buy them on margin. They borrow money to buy them. When those assets go down in value, margin calls happen. Can they meet those margin calls, or do they have to sell? And then if they sell, that pushes prices lower for all these mortgage bonds. Do other REITs have to sell? That's the reason why Tom Barrack is a little bit concerned about this. To put it a little bit differently now, there are large mortgage real estate investment trusts out there like Annaly Capital, AGNC, and Starwood Property Trust that have held up relatively better. And I would note this, Kelly, for AGNC, it's held up relatively well because it invests primarily in government-backed mortgages. So that's something to watch as well.
And Dom, when Tom Barrack warns about the banks, I mean, is there a systemic risk there, or should these concerns be concentrated in this asset class?
So there is, because of the whole financing structure, right? All of these banks do provide real estate financing. If the whole system starts to feel stressed, it's not just these mortgage real estate investment trusts that do, but perhaps the banks as well. And remember, a lot of stress is also on the investors in these mortgage real estate investment trusts, these MREITs, many of whom are older Americans, those who are looking towards retirement income. When you can't find that kind of retirement income with ultra low interest rates, with 30-year Treasury bonds trading with 1.5% yields, a lot of folks tend to buy these as part of a portfolio to augment some of those income returns. So that's something to watch as well. Boomers, aged Americans, those are the ones being hard hit as well.
Yeah, great point. Dom, we appreciate it. Thank you, sir. Let's turn to Diana Olick now in the big moves by the Fed lately, in part to support these markets. How could they affect the residential real estate market, Diana?
Well, it's just like Dom was talking about commercial real estate. Now the Federal Reserve is pumping billions of dollars daily into residential agency mortgage-backed bonds, and that is lifting MBS prices and helping some of those mortgage REITs that Dom was talking about. It also helped to turn around that spike in mortgage rates we saw last week. 30-year fixed jumped, and now it's finally dropping back. That spike, though, tanked refinance applications last week, down 34%. That might be a relief, though, for lenders who had been trying to handle the refi boom we saw earlier this month. But it's the servicers who collect your payments who are still facing a big problem. Fannie Mae, Freddie Mac, and the FHA have all announced forbearance programs so borrowers can delay monthly payments. But the servicers still have to pay the investors in MBS every month. The Mortgage Bankers Association has asked the Fed and Treasury to give them some kind of liquidity line to pay those investors, but still no word on that yet, and that does hit the MBS, Kelly.
So that's interesting, Diana. So the people who invested in these products say, I'm still owed cash flow, and if you're not getting it from the underlying product,
Absolutely.
You have to come up with it some other way.
Yes, servicers are contracted to pay those MBS investors. And if you're not paying your mortgage every month, then the servicers don't have that money. I mean, in normal circumstances, they certainly have enough reserves to do that if there's a small percentage of people who don't pay. But when we're looking at the spike in potential delinquencies over the next couple of months and the forbearance programs that we're going to see, that's going to be a lot for servicers to handle. And most of them just don't have that kind of cash. Yeah.